In a busy world where most people are focused on their daily lives, Cathie Wood, the founder and CEO of ARK Invest, is warning about a potential economic crisis. She recently spoke about different aspects of the financial world that, according to her, suggest trouble is coming. In this exploration of Wood's views, we'll break down her concerns and try to understand the story she's telling. Setting the stage, a macro view. Wood initiates her discourse by painting a macroeconomic landscape characterized by a critical juncture, a moment that she identifies as a cathartic moment. The crux of her argument lies in the dynamics of M2 growth, a key indicator of money supply. Wood contends that the growth trajectory of M2, which peaked at 27% in 2020, has been on a steady decline, possibly nearing or even falling below 3% on a year-over-year basis. This, in her assessment, leaves minimal room for economic growth or inflation unless money velocity experiences a great surge. However, Wood straightforwardly expresses skepticism about the possibility of such a surge in velocity, saying that people and businesses are becoming more cautious in their spending. In her eyes, this caution is exacerbated by the Federal Reserve's (FED) current approach, which she argues is the same as using a sledgehammer to tackle inflation.
M2 growth peaked at 27% in 2020 and has been slowing ever since. It hit 4.1% in August. We believe it is closing in or might be below 3% on a year-over-year basis in September, which doesn't leave a lot of room for growth or inflation unless velocity is really picking up, the rate at which money turns over. And we're in an environment where we do not believe velocity is picking up. If anything, I think individuals and businesses are becoming more concerned and are spending less freely. So if you look at M2 also, you'll see that it actually peaked in March. Now, this is very unusual to see sequential declines in money. We have not gotten back above that March peak, and we may not get back above it the way that Fed policy is going. And I think I'd like to build the case a little more here that the Fed is probably making a mistake. I say probably because I have to from a compliance point of view, but I really do believe the Fed is making a mistake. Reflecting a little bit more on the Jackson Hole speech that Chairman Powell gave in late August, we've come to recognize that Chairman Powell really does think he is the reincarnation of Chairman Volcker, that we need him to take a sledgehammer to inflation, much like Volcker did. And history has treated Chairman Volcker very kindly. He did turn the tide on inflation. Now, what he did, though, was he turned a tide that had been building for 15 years. It started in 1964 with the Vietnam War and with the Great Society. So many social programs started at that time under President Johnson. And for 15 years, fiscal and monetary policy pretty much went rogue as we look at history. Even after shocks to the system, like the oil embargo, the stimulus that came about because of it, both monetary and fiscal policy, we never saw the kind of slowdown in monetary and fiscal policy that we're seeing right now. Federal spending is still down 14% on a year-over-year basis. You never saw a decline in fiscal policy spending in the 70s. Monetary policy seemed to be on automatic pilot back then. The dollar was getting crushed toward the end of the 70s, adding to the inflationary fire. And so Chairman Volcker did choke off money supply and killed inflation. It took a long time for people to believe that inflation had peaked. In fact, I don't think Many people believe it peaked, as it did in 1981, until 1986 when oil prices crashed.
Historical parallels and the Volcker legacy.
So the inflation expectations and the inflation expectations were embedded in the system, and it was very difficult, and Volcker did a masterful job. So that was over a 15-year period that inflation had built. By the time the Fed got around to tackling it this time, it was not a 15-year problem. It was a 15-month problem. And from our point of view, it was caused primarily by shocks, major shocks to the system that we had never seen before. We had not had, since Spanish influenza, a global pandemic. And we did not have the supply chain problems, 2 years worth of them, that we had because of the COVID panic. And then, of course, we had another shock to top those off, and that was Russia's invasion of Ukraine. So these are shocks to the system. This was not a period of embedding inflation expectations. And yet, Chairman Powell is taking a sledgehammer that is actually bigger, much bigger. It's at least 6 times bigger right now, and could be 8 to 10 times bigger if the Fed does raise the Fed funds rate another 75 basis points on November 2nd. And what do I mean by that? Well, Chairman Volcker was dealing with double-digit interest rates. He took interest rates from 10% to 20%. Now, by the time he did that, consumers and businesses had gotten used to maneuvering around inflation. So while that sounds shocking, going from 10 to 20%, and it did have some shock value, it wasn't the same as what we're experiencing today with Chairman Powell and the Fed. Today, we've gone from 0.25% on the Fed funds rate to 3.25, which is a 13-fold increase, not a 2-fold increase.
Drawing parallels to the past, Wood invokes the spirit of Paul Volcker, the former chairman of the Federal Reserve, who successfully curbed inflation in the early 80s. She acknowledges the success of Volcker, but emphasizes that his actions were in response to a 15-year buildup of inflation, a stark contrast to the 15-month inflationary challenge facing the economy today. Wood critiques the current Fed, led by Chairman Powell, for employing a sledgehammer that she deems 6 to 10 times more significant than Volcker's, particularly when considering the starting point of interest rates. The narrative intensifies as Wood dissects the Fed's response to the recent economic shocks, citing the unprecedented challenges posed by the global pandemic and supply chain disruptions. She questions the rationale behind a monetary policy that appears more aggressive than the circumstances warrant, arguing that the inflationary expectations embedded in the 80s are absent today. U.S. debt.
People dismiss this way of thinking about it, saying, oh yeah, but the base was so low. The base was so low, and it had been really since 2008 and 2009, because we were in a terrible crisis then, and it took a long time to get out of it. And so we did not have inflation expectations built into the system. I really don't believe at all. And yet Chairman Powell is behaving as though what's going on today with inflation is much worse than what Volcker inherited. Starting from a low base is really shocking the system, especially given how long interest rates have been low. So I question the premise of those who say, oh, this is so different. It's such a low base. That's the whole point. It's a low base, 13 times. So if they raise the Fed funds rate another 75 basis points, this will be a 16-fold increase compared to Volcker's 2-fold increase. Now, we have been expecting serious ramifications, financial and other ramifications, because of this monetary policy. And we've gotten the first one. But most people here in the United States are not aware of it or haven't thought very carefully about it because it doesn't seem to matter to us. But I was in the UK around the time that it had its near Lehman moment. Near Lehman moment means the financial system implosion. And that was just about 10 days ago. Now, what do we mean by that? Well, there is something called LDI, liability-driven investing, and it's where pension funds match their liabilities with assets. So they will, in its pure form, they will match one for one the amount that they have to pay out to pensioners as they retire. Now, it would be great if they did match assets with liabilities completely from a safety to the system point of view. But they don't. And with banks, and a very low interest rate environment, they got used to using derivatives and taking shortcuts to try and accomplish the same goal. And after a very long period of very low interest rates, I heard someone say the other day, and we were talking about this LDI crisis in the UK, that the reason it's so serious is pension fund sponsors were beginning to think, and banks were beginning to think, that interest rates would stay very low for a very long time, for as far as the eye could see. And that assumption was built into the kind of derivative activity they were doing. No one expected a sharp increase in interest rates. Well, once that happened, pensions began getting margin calls, and they couldn't meet them. And in fact, if interest rates had gone to 8%, and I think they got to 6% over there, if they got to 8%, then according to some of the people close to that situation, whom we have consulted, then the pension system would have collapsed. But it wouldn't really have been the pension system. What really would have collapsed if the pension funds were not meeting those margin calls were the banks, the counterparties in this case for these derivatives. And so the Bank of England had to step in and basically say pretty much the same thing that Draghi said, the chairman of the European Central Bank in 2011. He basically said, we're going to pull out all stops no matter what. So while the BOE had been almost forced because of currency depreciation into following our Fed with higher interest rates, this was going to cause a great deal of harm to its system, and so it had to reverse its policy. So this is another reversal in policy, or it's a bit of a shift in policy. It's an outright easing, and they said they will continue until October 15th. So now all of these pension funds, in collaboration with the banks, are deleveraging, and they have till October 14th. So what do you do if you're deleveraging in an illiquid environment? All markets are experiencing duress today. I think the Fed is a big part of that. So what do? You sell the most liquid assets. What are those? Those are government bonds. And so we're seeing U.S. government bonds, which are held in pension funds abroad, being sold, even though deflationary pressures are mounting all over the place. And so we think this is a bit of a financial crisis, and we think we'll see it elsewhere as the Fed continues to raise interest rates, as it seems want to do. Certainly this week was full of speeches from all the Fed members reminding everyone that they're going to take interest rates up until we get to 2% inflation. Well, So we'll see what happens on October 14th. By that time, I think they will have been deleveraged and will be past the maximum pressure associated with this guilt trip.
Debt crisis and the gold rally. Wood pivots to the U.S. debt crisis, signaling a potential catalyst for a long-term rally in gold. With the addition of $8 trillion in debt since March 2020, Wood notes that gold has surged by 50%. In her eyes, buying gold and silver becomes a defensive strategy, a hedge against uncertainties stemming from a lack of trust in elected officials in Washington, D.C. While many dismiss this skepticism, Wood contends that the uniqueness lies in the starting point, the low base post the 2008 financial crisis. The juxtaposition of a 16-fold increase in interest rates compared to the 2-fold increase during Volcker's era adds to the gravity of the situation in Wood's analysis. Global ramifications and currency interventions.
We're seeing other changes. We've seen China intervene to limit the weakening of the yuan. We've seen Japan doing the same. Now, what is that? What are they doing when they do that? Well, when Japan is trying to support its currency at 145 yen to the dollar, what it does is it sells dollars and buys back yen. Now, that's good in a way. It's doing some of what the Fed should be doing here, actually. It's providing dollar liquidity to the rest of the world. China is doing the same thing. And so we'll see what happens from here. I think this is getting to be so serious that we are reaching a cathartic moment. And I do think it started with the guilt trip. The Fed has acknowledged that there are international ramifications to what it is doing, but it is thinking first and foremost about the U.S. This reminds me a lot of the early 80s and what happened in the early 80s. There were two accords, the Louvre Accord and the Plaza Accord, where the Treasury ministers around the world all agreed to sell dollars to limit the deflationary impact on the rest of the world. And when I say deflationary impact, there are countries, sure, their currencies are falling apart, so their inflation rate they look like they're in hyperinflation or heading in that direction. But they are being strangled by dollar-denominated debt that they cannot service. And so this ends up being quite a deflationary situation longer term.
Wood expands the lens to encompass global repercussions of the Fed's policies. She draws parallels to historical accords in the 80s, such as the Louvre Accord and the Plaza Accord, where nations collectively aimed to limit deflationary impacts. Expressing concern for other countries grappling with dollar-denominated debt amid currency depreciation, Wood sees a potential for an international deflationary scenario. Highlighting interventions by China and Japan to stabilize their currencies, Wood interprets these actions as a form of providing dollar liquidity to the world. The analogies to past global economic coordination raise questions about the Fed's current approach, seemingly focused primarily on domestic concerns. We're wondering what in the US is the weak link. Is it our pensions? We don't know. We know there are LDI strategies in the United States. They're not as leveraged as we understand, but no one knows. If not that, what are some of the weak links that we're seeing? We've been worrying about auto credit for a while now, and now we have more reason to. Yesterday, we got the Manheim Used Car Index. It's a value index pricing effectively, and it dropped another 3% plus. It was a 4% plus decline last month. And so what we have now is the year-over-year increase has gone from 54% in April of 21 to minus 0.1. So there you go, Fed. There's another indication that deflation is in the system. That index peaked in January and is now down 14% just since January. It's declining at more than a 20% rate. Potential threats: pensions and auto credit. Looking closely at vulnerabilities within the United States, Wood highlights areas that could pose risks to the economy. She points to a crisis in liability-driven investing, LDI, in the UK as a warning, where pension funds faced financial pressure due to a sudden rise in interest rates. Drawing parallels, Wood suggests that U.S. pensions may also be susceptible to risks. Another worry for Wood is auto credit, specifically focusing on the used car market. Using the Manheim Used Car Index as a gauge, she shows a significant decrease, indicating potential trouble in the auto industry. Wood predicts a ripple effect as dealers dealing with large inventories may be compelled to sell, potentially triggering broader consequences.
Now, why is this important? Well, a lot of auto paper out there makes assumptions, or the investors make assumptions about the residual values of cars. And those residual values have been going up, maybe not as much as the used car index, but they have been firm. If we're right, the used car price index is going to collapse here. Why? Well, many people bought cars during COVID because they wanted to avoid mass transit. Under normal conditions, they didn't need that car. Nonetheless, they were quite happy to see used car prices going up, with the thought that when the coast is clear, they would sell back into the market, into the used car market. And as I mentioned, used car prices were up 54% on a year-over-year basis at one point. Now they're flat to down. And now dealers who were paying too much for used cars are sitting on losses, and they are going to have to disgorge those inventories. Because inventories cost money to carry, especially as interest rates are going up. So they're going to be forced to sell. And we believe that's already happening. And there's about $1 trillion of auto paper. Now, this won't be a systemic risk. But because auto paper was the best performing paper during 08-09, this is going to be quite a surprise to a number of investors. What's another weak link in the United States? Well, corporations have a lot of debt. Why do they have a lot of debt? Well, they've been catering to short-term shareholders who want them to buy back shares and don't mind that they're leveraging up to do so, or they want them to pay dividends and don't mind that they're leveraging up, becoming more indebted. Well, this is becoming a big problem for certain sectors of the economy that are in the throes of disruption, both cyclical and secular. And I think the retail sector is one of those. We remain astonished at the inventory buildup taking place out there. And the way we're looking at this now from a deflationary point of view, and we think that's the bigger risk now out there, is the pipeline is full of deflationary indicators, starting from commodities, and we'll get into that in a moment. But at the end of the pipeline, downstream at the consumer level, retailers are awash in inventories. And the latest one, pretty provocative, is Nike. And Nike is both a retailer, but it mostly sells to retail.
Corporate debt and retail challenges. Wood focuses on the corporate world, highlighting the burden of debt carried by companies aiming to meet short-term shareholder expectations. She sees the retail sector as being on the verge of disruption, with growing inventories as troubling signs. Wood points out Nike as an example, noting a 44% increase in inventories as a broader issue in retail. According to Wood, the inventory problem could lead to deflationary pressures for consumers. She warns that if not addressed quickly, signals of deflation starting from commodities could escalate into a full-scale crisis. Data discrepancies and market turmoil. Wood questions the Federal Reserve's claim of being data-driven, providing evidence from commodity prices to historical inflation patterns. She highlights significant declines in commodity prices like gold, copper, lumber, and oil as counter-arguments to the Fed's stance. The markets, according to Wood, are reacting to disparity with a widespread sell-off, signaling a crisis that requires the Fed's attention. The dawn or darkness. In her closing remarks, Wood paints a picture of a world on the cusp of a cathartic moment, echoing a sentiment that change is imminent. She expresses hope for a pivot in the Federal Reserve's approach, urging a departure from the need for unanimity and a united front. Wood contends that the Fed should embrace the diversity of opinions among its members, allowing for a more nuanced and adaptable response to the challenges ahead. As the financial landscape stands at a crossroads, Cathie Wood's warnings serve as a thought-provoking analysis of the risks and vulnerabilities inherent in the current economic trajectory. Whether her predictions materialize into a full-fledged recession or prompt a recalibration of monetary policies, only time will reveal the true narrative of the economic path ahead.